speaker, Mr. AgneloRajesh Athaide. Mr. Athaide is the chairman of Global St. Angelo's Professional Institute. His goal is to develop businesses with high growth prospects, strategically scale up, achieve high ROI, and become well-established brands. He is the author of Obstacles to Opportunities and 50 New Life Mantras. He is the president of Corporate Connections Mumbai chapter and the director on board of the Christian Chamber of Commerce and Industry. AgneloRajesh's business, which started with a single computer, has now risen to a level where he is one of the well-known and successful serial entrepreneurs of the day. His business interests have been in education, edtech, real estate, restaurant, hospitality, e-commerce, architects, online platforms, and business mentoring. He believes a real business is about actually building relationships. So please give a huge round of applause to Mr. AgneloRajesh Athaide.
So good afternoon, guys. What a pleasure to be here in the same room full of people, interesting, exciting people from different walks of life on a working day, on a Tuesday. So amazing to see everybody. And rather, that was a very interesting and inspiring session. Definitely, India is a growth story. And like you said, right, you rightfully said, India is the Switzerland of today and tomorrow. So I have a presentation if we can go through that. Getting invested or getting funded is the topic of the day. There are some very interesting and inspiring people in the hall. Some of them whom I know, like I was speaking to Mr. Cheda and he was talking about how he can mobilize 30,000 families into entrepreneurship and change the fortunes of people. So the excitement today is becoming an entrepreneur, and that's the flavor of the day. There are people, when you're getting invested or you're getting an investor or you're looking at an investee, you can definitely look to people like Vinit Bansode who can do signature analysis of the investor and the investee and predict whether this relationship can last or not. So there are solutions for every situation. You get funded and you can put on weight. There is Neha Ranglani here who can definitely be your dietitian and help you on how to not to gain weight but to gain more profits to the invested money. So you have got all formulas present. We have got Naina Parekh here, a very dashing, young, dynamic woman entrepreneur. So the woman power also in India is multiplying. So this is the right time, the right season to get invested. It is a marriage of two requirements. Somebody wants to invest and somebody wants to get invested by. So thanks to Yes Bank and CapSavvy, Cap70 Sharks. Thank you, Mr. Anil Goel, for this wonderful platform. We'll just go through a very quick presentation. The next slide, if you can help me with the slide. So friends, the current startup ecosystem in India is very fertile. In fact, in the first half of 2022, we were the second highest country for creating unicorns. That's a great story. These are some of the logos of the companies which have become unicorns in the last couple of months and years. Next slide. So what should an investee company look out for? An investee company should not take investments from anybody and everybody. There needs to be parameters on whom should be considered as an investee. So one is understanding the investor style and metrics. Don't try to accept just because you need money for investments. Don't commit the mistake of taking it from anybody, but try to match the investor with your ethos. So understanding investor style and metrics, analyzing investors' ownership patterns. There are some investors who will overpower your thoughts and style of functioning. So probably that might become a wrong match. So you need to see and analyze investors' ownership. You need to be as an investee hosting investors so that they can know you better as entrepreneurs and then have the belief and confidence in investing in you. And as investees, you looking out for investors, you need to be attending diversified conferences. This is one of its kind where you can really understand what should be your role as an investee and what can be the role of an investor. Next slide. So what should the investee company showcase to get investors on board, to get bigger entrepreneurs on their board? So one is passion, second is traction of the market, third is significant market size that can be explained by the investee to the investor. Then competitive advantage, how you are different from the market. Anything and everything that you ever wanted to create is already created. There is no invention available, there is only innovation available, and the innovation happens just by a difference of 1 to 5%. You cannot make a new aeroplane, you can make a faster aeroplane. You cannot make a better car, you can make a faster car, you can make it more comfortable. There cannot be a car with 5 wheels, it will be still 4 wheels. So you need innovation on how you can make your product or service better. So you need to create the competitive advantage. The investor will look at the team, Jaisa Raja Vaisi Praja. और जैसे हम कहते हैं ना गंगा ऊपर से बहती है. So the people who want to invest will want to see the team behind the organization, then investment flows. And the exit strategy. Every investor, before he gets in, he wants to understand when, how, and where he will be able to exit. So all these parameters need to be well defined before you start your conversation with any investor. Next slide. Friends, the target audience or customer base of an entrepreneur or startup is critically important for an investor to understand. Once he understands your target audience and once he understands why that target audience is your audience, and you can reach them, you can pitch to them, and you can convert them to customers, you definitely will be gaining the investor's confidence. Asking yourself a few questions about your ideal customer can help you define your desired customer base. सभी लोग मेरे customers हैं. This kind of statements don't work on investors. Next slide. The cash flow of a business is critically important to be explained to the investor. Like, for example, the operating cash flow, the money your business generates and spends on a regular day-to-day basis activity. Now, this is the cash flow that people understand. But the investor would also want to understand the next two categories. That is the investment cash flow, the money spent on and generated from market securities, long-term assets like properties and equipment and other financial instruments over the reporting period. That is the second kind of matrix that the investor would like to understand. And the financing cash flow. The financing cash flow is the money which moves beyond and between a company's owners, investors, and creditors. So this is the basic data that any investor would like to understand for a company which is looking out for investments. Next slide. Friends, how will valuation be calculated? There are various methods. A investee or the company which is wanting investments needs to understand how is it going to express and explain to the investor on what is the valuation matrix that he has decided. So there are a few methods. The Burkus approach, an idea of the potential value of a startup. You need to go in deep on these topics so that as a investee company, when you learn these methodologies, you'll be able to explain to the investors in a much better language that he understands, and you will be in a better position to explain. The cost to duplicate approach. The cost to duplicate approach is very interesting. A software company once came and said that I am valued at 25 crores, and somebody sitting in the room said, I can build what you built for just 50 lakhs of rupees. So why are you valued at 25 crores? Why are you valued at 50 crores? You need to have valid data reasoning and details to impress upon the investors. Future valuation method. Valuation theory that estimates the return on investment that the investors can expect in the future. You need to have a balance between your current scenario and this future calculations that you are having to justify the valuation that you have arrived at. Next slide. Friends, market multiple approach is the valuation theory which is based on the idea that similar assets sell on similar prices. Like every sector has parameters and benchmarking about the price points that can be considered while creating a valuation report. So that's how market multiple approach happens. Risk factor summation method, a rough pre-money valuation method for early stage startups. All the companies who want to get invested have to connect with themselves with one of these methods to explain the valuation and the justification of the valuation that you are going to be asking. Discounted cash flow method is a valuation method that estimates the value of an investment using its expected future cash flows. If you don't achieve those expected cash flows, the valuation automatically drops proportionately and you will get lesser money, or you will get the same money for higher equity. So please be careful on which method you are adapting and explain it to the investors accordingly. Next slide, please. What will an investor look for in a potential entrepreneur? This is a very important slide for all the companies who want to raise money. Well, the investor will look for a great product or service. There definitely needs to be a differentiator. Point number 2 is the potential to grow. How much more can you exceed in your market size? Your market cannot. Today, global is a new local. You need to be local. You need to be accessible globally. Also, you need to be powerful locally. So if you are local, your chances of getting invested is very, very high. So there should be a potential to grow. A passionate and dedicated founding team where each founding member has a specific role assigned to him. Like yesterday I had an interaction with Neha Ranglani. She is starting up a venture, and a very interesting thing that she has done. She has got 5 founding partners. There is a definitive role that each founding partner is going to play. As an investor, when you come across such teams, you feel very motivated to align with them and invest into them. The business needs to be sustainable and ethical business. Any business which can create impact in the society gets the fastest investment. But it should not be a flaw or it should not be a makeup. It should be in reality that the business that you are driving needs to impact the society in a very positive way. And of course, it has to be ethical in nature. The law of the land catches with you sometime or the other. So you need to be crystal clear from day one that all compliances need to be in place. Strong financial plans. The entrepreneur needs to have clarity on the money that is wanting and how it is going to be deployed in the business. There needs to be clear plan for the use of investment money, and risk assessment and damage limitation plans need to be in place. Like what can go wrong, and if things go wrong, what can be the corrective measures. You can't scratch your head after the plan has gone wrong. You need to be prepared before you take the first step. So these are some of the interesting points. Next slide. So what should an entrepreneur look for in an investor? Ability to fund, reputation for funding repeat rounds of investment, diversification. The entrepreneur who's an investor can also give you the possibilities and opportunities of diversification on the same funds, the same activities, and the same resources. Influence. The investor should not only give you money, but he should also give you influence. According to me, an investor as a strategic investor is a better investor than only a money investor, because a strategic investor will open up his relationships, will open up his influence, and will open up business opportunities for growth. Fit for your brand and culture. You need to profile check the investor before you say yes, so that it is not only the need of you requiring the money, but it is also the need of the investor to multiply his money through you. The control and intent. How is the investor going to control your enterprise after he has invested? You need to have that conversation absolutely clear and then take a step ahead. Next slide. So what are the mistakes to be avoided once you get the investment? The mistakes to be avoided is your plan should be perfectly in place, not after the investment is done, but before the investment can come on board. So there should not be any lack of planning. There should never be lack of focus. Machli ki ek aankh. That is a story that Mahabharata teaches us, right? कि आपको क्या दिखती है? And the person says, I can see only the eye of the fish. Every entrepreneur needs to be razor sharp on his focus in the direction that he wants to go and in the direction that he wants to grow. Not only himself and the organization, but also the investors' money. So the last point is not nurturing relationships with investors. Once you get invested, the relationship between an investor and investee becomes very delicate. You need to be mindful about it, and you need to handle it diplomatically and with the right spirits. Next slide. So what is forward integration? So there are two concepts of forward integration and backward integration. If your company can become one of them, either a forward integration or a backward integration, automatically the company who's investing in you or the entrepreneur who's investing in you, not only will he invest money into you, but he will also give you steady and captive business. So if there is a possibility of a forward integration or a backward integration, that is the best scenario of an investor that an investee company can have. Next slide. Next slide. So how can the entrepreneur explain the further course of action after getting funded? Very easy. You need to deliver on your promise. Your projections should be under promising and over delivering. So you can absolutely deliver on your promise. Set the next set of goals. Realign the team. You might be having a player playing some different role. You can realign the team for better results after you judge that these skill sets can also be used somewhere else. Update the financial model, decide how much goes to reserve, say no to unplanned expenditure, and start planning for the next round. The first round of funding will help you to establish your foundation, will clear that your model is a successful one, and will multiply your value multiple times. And after that, you are now ready to get to the second round of investment. Friends, who's your first investor is going to define the rest of the journey of valuation that happens. Like for example, you're a 5 crore company and Anand Mahindra has invested in it. Without doing anything, before the sunrise of the next day, you will be valued at 100 crores. Nothing changes. Your paper is the same, you're the same person, the office is the same, the team is the same. But the man who has invested in your company is somebody dramatically different, and the world reads it. If Anand Mahindra has invested it, this is a 100 crore deal. So get 5 crore company, get Anand Mahindra as an investor. The rest is history. People will want to associate with you and invest in the next rounds. So these are some of my social media handles. We can get connected. Investment is a passion. The journey and the life forward is going to be growth through the growth of investors, through the growth of entrepreneurs. So Now, the model of my life has been, instead of investing in employees, I want to get entrepreneurs engaged, make them grow, and grow overall as an organization. Thank you so much. Have a lovely afternoon.
Requesting Mr. Athaide to please join us back on stage. Sir, just 1 second, join us on stage, please. To thank you to let us know about how to manage our finances at a new startup, I would request Mr. Saurabh Shah from Yes Bank to felicitate Mr. Athaide. I would now like to welcome